Hi, good friends. Welcome once again. We want to move on to the concept of ethics, okay? Ethical standards and rules of professional conduct or code of ethics. Every profession has its own rules of regulations and, of course, its professional code of ethics, because ethics is important. We need it to ensure that people do the right thing, okay, to ensure some sanity within the system. Those of you who progress to final year, you take a course in enterprise risk management, and you'll be able to understand some theoretical foundations underpinning ethical structures. Okay, so you hear the deontological ethics, teleological ethics, justice and fairness, okay, feminist ethical theory, okay, business ethics theory or business virtue ethics theory, a lot of them. We are not going into the theoretical frameworks of ethics. We are looking at the application of it in auditing, okay? So as usual, I'll share my screen and then we'll move on. We'll move quite fast because I know this is not the first time we've heard of the ethical code of conduct underpinning the professional accountancy practice. So you might have heard it and seen it in your previous studies. So we just want to go through, okay? But we then want to narrow it down to our audit practice, okay? So at the end of the day, you want to be independent from the client. We've already looked at principles-based approach and rules-based. We are within the principles-based approach. It doesn't mean the rules-based approach or systems do not comply with ethical codes of conduct. Typically, they also comply with the same ethical codes of conduct that we have. The 5 key ethical principles, we know them, but I'll look at some features, advanced features of how to comply with these ethical principles. What are the threats that will cause us to compromise our ethical behavior? Every audit firm will usually have an ethics partner, or a quality control, review control partner. They could be the same, they could be distinct, okay? We also want to see various prohibitions that which could serve to maintain our auditor independence in the firms. What about contingency fee arrangements, provision of non-audit services? Okay, like I said, or like I've always been saying, this is a summary of the text. Chapter 6 is what we are dealing with, and I'll be happy if you spend time to go into the text. I'll not touch on all of them, especially contingency fee arrangements. I'll not touch on it much. Rules relating to insider trading, I'll skip that. I'll go on. I'll dwell more on the money laundering, whistleblowing principles, and public interest. I want you to read that one. Okay. All right. So the auditor sometimes will always find himself in a conflicting situation because to his left, he's got issues with considering his self-interest, okay, because he gets some audit fees, some non-audit fees to survive as a going concern. And management is also giving them pressure. Okay, so should I succumb to the pressure from management and lose this revenue turnover? Okay. On the right-hand side, he's got the supervisory bodies, recognized supervisory bodies watching him, making sure that they do the right thing. So he wants to protect his firm's reputation and not to lose his personal reputation. He doesn't want to collapse. So there should always be a balance between the two divides so that you'll find yourself surviving into the continuing future period. So we want to always have ethical codes of conduct within the profession so that our credibility will be high. When they hear of KPMG, they know, well, these guys are quite professional. They know what they are doing. They hear of Grant Thornton. They know these guys, their credibility is quite high up there, all right? So ICAU, ICAS, the RSBs, okay, they always have codes of ethics or codes of professional conduct. Okay, go online, Google ACCA code of ethics, ICAS code of ethics. In fact, CIMA itself, though they don't have, you will say they don't come in under the realm of auditing. They also have the same code of conduct which they use, they apply in their workplace. They also have the same thing there. So it's interesting how CIMA, though they do less of audit or none of audit, they still look at this. Like I said, the approach is not rules-based. Okay, so more of principles-based. Yes, principles-based. What we want you to know is that you must adjust the situation as and when you find yourself. Okay, we've looked at the advantages or the features, the merits and disadvantages of principles-based and rules-based. Quickly, we know rules-based, they are more certainty. Definite prohibitions are provided, capable of interpretation because you find a decree well spelled out. It cannot deal with any situation at all. It deals with specific situations, and sometimes, or most of the times, they are inflexible. But with the principles-based, it's flexible. You find yourself in any situation, adjust to it, okay? You can apply it across various boundaries. The onus lies on the auditor to prove himself right in any situation he finds himself. It can also include some specific prohibitions. It tells you, we'll look at some examples, okay? But again, it lacks precision, which could lead to people misinterpreting the rules to suit their own whimsical caprices. That's not what we're looking at. We don't want it to happen, but it happens, okay? So I'll skip these various advantages and disadvantages, covering the rules-based and then the principles-based, okay? We looked at it in previous sessions, so I want to skip this and then proceed. Look at the corporate governance section. We'll look at this in detail. So I want to skip this one as we move on, but we've touched on some of them. So the fundamental principles or ethical codes of conduct are 5. We know them, okay? And it has remained so over time. Most audit firms will always have these ones embedded in their core values, okay? When I was with KPMG, I remember we had 7 core values, and the last one says that above all, we act with integrity. So you realize that the core principles were embedded within, okay? So integrity simply says that do the right thing when nobody is watching you. Do the right thing when no one is watching you, okay? Objectivity, don't let someone influence your judgment or your work. Don't let somebody, let me say, impose some undue influence upon your work, say that you end up being biased, okay? Always competence and due care, we've looked at this under auditor liability, okay? This one clearly underpins the auditor liability section. So always upgrade your technical know-how to the highest level. And remember, you owe a reasonable duty to care for those who have proximity to your results, to your report. You know that somebody will rely on your report to make an informed decision. Make sure that you give him the right information. Do not let the person be misled by relying on your report, okay? Confidentiality, in the course of doing your work, if you find any good information, any information, don't use it for your own personal gain. Keep it to yourself unless you are being pressured under a legitimate cause to unravel the information, maybe for the sake of the public interest, or a court has issued a subpoena for you to release the report. Then you can do that. Otherwise, keep the information as confidential as possible. Professional behavior. Listen, the fact that you're an auditor, you go out in suit, in tie, gentle, people see you, they respect you out there, doesn't mean you should go out and live a terrible personal life. You go out at weekends to drink, booze, find yourself in gutters, and then people have to always carry you to your home. You think that's my personal life, that's me, okay? You go about tarnishing the image of the body to which you belong. That's why if you are a professional, an auditor, okay, a chartered accountant, and your personal life conflicts with what the profession dictates, you can be withdrawn from the body. You can be expelled, okay? So don't go about beating your spouses, causing all sorts of terrible drama, coming into the news and disgracing the profession. You might think it's your personal life. No. Professional behavior cuts across both official and personal lifestyle, okay? Oh, I've gone too far. Okay, let me go to this one. Now, like I said before then, let me go back. So the FRC actually issued this, the IFAC issues these fundamental principles, okay, but they are derived from the International Ethics Standards Board for Accountants, okay. Now they've proceeded. FRC had provided some guidance on how we can comply with this accountability, okay, have regard for the wider public interest, okay, in addition to having the interest of your clients at hand or at heart. Integrity is, like I said, truthfulness in all situations, okay? Objectivity and independence, impartial opinions, don't be affected by bias, prejudice, don't like somebody because of his race, because the director bears the same last name as your name, though you are not related, and so you want to favor them. Don't compromise on your goodwill, okay? Competence, like I said, professional skill, rigor, be tough, be thorough, be meticulous, be detailed in your work, okay? Let people know that this guy is coming. The guy is quite tough. He knows what he does, and he's quite detailed. Clear and effective communication is always important. Express your opinion without fear or favor that somebody could intimidate you or somebody could cause you some harm. Association, allow reports to be included in the larger documents as long as there is no inconsistency. So if there is a sustainability report which could augment my financial report, integrate it into one annual report. And again, provide value. Make sure whatever you are providing adds value to someone who would use your report. Okay, don't just produce the report and people see and say, this is useless. It doesn't add any value to my life. Somebody reads and says, wow, this is what I was looking for, okay? So the RSBs, ACCA, ICAS, they fundamentally subscribe to these 5 ethical codes of conduct, okay? But both the ACCA and ICA, you have a code which includes objectivity and integrity, but not independence as a separate item. They sometimes want to merge it, okay, within. They also include the other 3 that we already know, derived from the code of confidentiality, competency, and due care. So they have this, okay. Let's move on. All right. What are the safeguards within the audit accountancy profession? There is always an entry requirement. That's why even when you qualify the ACCA, you don't immediately become a member. You become an affiliate. Over time, you fill the practical entry forms to prove that you qualify to be accepted into membership, after which you later move on to become a fellow. So strict entry requirements, you always have to have a CPE, 40 credits. Every year, I'm talking for the ACC, I don't know about the rest, but I'm sure you will also subscribe to similar threshold for CPE. Corporate governance regulations actually apply to the profession, the audit profession. And then, of course, professional standards are there, they monitor us. There are external reviews from these bodies, okay, on the audit firms, okay. Within the audit firm itself, they will always have, they will always have a quality control system or quality review system. That's why most audit firms will have a quality control and review partner, or even an ethics partner, okay. Within the firm, they also try to rotate the audit teams, so you don't stay on HSBC audit for forever. After certain years, 5 years, 3 years, they change you. Okay, again, within the firm, when we get to a dead end, we could consult third parties, even seek legal advice, okay, and ask them for guidance. It is important. That is why you see in the audited accounts where audit fees are always disclosed, audit expenses are clearly disclosed, okay, to avoid any issues of conflict of interest. There are threats that could impede or cause auditors' independence to be lost or to be questioned. Self-interest. If I have a share in the client I'm auditing, what do you think? What will happen? Okay, if I have some interest in it, financial interest, that I get some dividend from HSBC, and I go into audit it, what do you think will happen? If I prepare the payroll accounts, or I put together the financial statement of HSBC, and I go into audit the same work I have prepared, what do you think will happen? What do you think will happen? I'm asking you questions, okay? If I am the type who will have to represent HSBC at the bank because they've been called upon to clarify certain issues, and I go in to stand in the docket and represent them and defend their accounts, and I go back to audit them, I'm preparing an advocacy thing for them, what do you think will happen? What do you think will happen when I go to audit them? I audit and I present and I advocate for them and I fight for them. What if my partner, my wife, is the CFO at HSBC, or my daughter has just been promoted, gotten a job there as the director of finance, and I have to go and audit my daughter? What do you think will happen to my work? Will my independence be genuine or impaired? Okay. What if the client tells me that, listen, your income over the whole year is, I have seen, is 10 million. I contribute to 5 million. So your overall turnover for the year, the client contributes about 40%, 50%. What do you think will happen? This guy can intimidate me, because if I lose this client, I lose a lot of income. Okay, and I'm not too sure when I'm gonna get a new client. So these are the threats. Okay, there's a key principle I want us to look at when we talk of independence. We should not just conceive that independence exists between the client and the auditor, but we must actually see that it exists. Okay, so we should approach our work with an independent mindset, ensure that our independence is not seen to be compromised in any way. Okay, so you go to the client's office, and the next time we see you dating the secretary to the finance office. I'm not saying your audits should impede your love life, but be careful that it's not seen as you compromising on your integrity, okay, or your independence. Now, key principle I mentioned, auditors should consider their independence from the perspective of an objective, reasonable, and informed third party. Somebody sitting outside, how would they see you dating the secretary to the CFO? How would they see you? Okay, but the question is, who is an independent, objective, reasonable, and informed third party? It's not clearly defined. Okay, it's not clearly defined, so sometimes it raises questions. Is it a shareholder? Is it a director, or any other person out there? Okay, any other person out there, who is it? That raises a question of who an informed, reasonable third party is. How do we ensure independence? There's a three-pronged approach. Identify the threats inherent in the organization or in your audit engagement and how it could impact your work. Okay. Evaluate the significance of this threat. Like I said, how would it impact your work? The extent to which it will impact your work. You can do a simple risk mapping, look at the probability and then the impact extent of that affecting your work. And of course, put in place safeguards to eliminate this risk or reduce the risk to an acceptable level. Now, ISA 220 talks of quality control for an audit of financial statements, and it requires all audit firms to review their relationships with their clients on an annual basis. Okay, and whilst they are reviewing, they should check whether it is proper to continue with the engagement or to curtail it. Any threat to their objectivity should be considered, and if you know it will affect your reputation, please curtail it. All right. Confidentiality. Clearly, not all information derived from the client could be confidential. If you realize that this guy is engaging in some money laundering, terrorism, drug trafficking, you don't want to keep it. You must protect the public interest. So this information, you have to disclose it. Okay. Again, like I said, if you realize that this bank is not operating in line with the regulations set by the financial financial sector, the central bank has issued a minimum lending rate of, let's say, 3%. Okay, let's say LIBOR plus 3%. And then you end up inflating it to like 32%, killing your customers with high interest payment, because you know your interest income from these clients will form your major turnover. You have to report it. Okay, you have to report it. If you are ordered by the court issues a subpoena, the law requires you to report. You must disclose this information. It doesn't violate the confidentiality. Okay, and again, remember, if it's for the public interest and for your own interest, you must always disclose it. There are tricky areas. I mentioned overdependence on one client for a significant portion of your income. It's a tricky area. We'll look at some safeguards. Again, like I said, self-review, you prepare the account, your payroll, and your audit is not the best. Promoting advocacy, familiarity, intimidation, okay, legal action. If the client threatens you with an illegal action, It's not the right thing. Okay, it could be, it is terrible, it is dangerous. And so you may lose impartiality when reporting. There could also be conflict of interest. You must avoid acting for both sides. Okay, so again, you are even cautioned if you have two clients, for example. I know these two clients are at loggerheads somehow. Two banks. Let me cite a fictitious, let's say Richard Bank and Rachel Bank. You know these guys are at loggerheads, and you are the auditor for both banks. Be careful. Okay, review the situation, and if it will compromise your independence, you must take safeguards against it. With the fees, like I said, there's a 15% rule for all companies who are not listed on the stock exchange. If the revenue you are taking from them constitutes more than 15% of your gross income, you may want to stop that engagement. But for a listed company, if the income you get from them constitutes more than 10% of your gross income, you may want to consider your quality control procedures and necessarily possibly pull out. For public interest entities who will contract the audit firms for non-audit services, the rule is that whatever amount we pay them should not exceed 70% of the average of the audit fees we've paid them over the past 3 years. Okay, so if the consecutive past 3 years we've paid them 100 million as audit fees, the average is 100 million. Okay, the average. Remember, when you contract them for a non-audit service, whatever you're paying them now should not exceed 70% of that average, the average being 100 million. All right. The FRC requirement is for fees above 5%. Here we are being told that any fees you obtain from the client, which is above 5%, the engagement partner must disclose this to their senior partners and to the ethics partner, or even to their quality review control partner. Now, any fees which the client has not paid you should be considered as loan. Okay, so you must make all attempts to collect that money ahead of time. If somebody is owing you and you are still going back to audit the person, you may be tempted that, listen, if I don't do a clean job, these guys will still owe me. They will not pay me. So any money unpaid, any fees unpaid, consider it as a loan. You cannot accept percentage or contingency fee arrangements. So I will leave, like I said, look at the contingency section and read more on the contingency fee section. Okay. So usually, sometimes they will tell you that, listen, there's a goal, there's a target. We are going to use your financial report, the audited statement, to go and get finance, to go and take money loan. Okay. If you give us a bad report, we'll not get the loan. If you give us a good report, we'll get the loan. So the auditor is tempted that I need to do it so that they get a clean report, even if they don't deserve a clean report, because at the end of the day, you may be paid maybe 2% of that loan. Some contingency fee. It cannot be done. It cannot be done. Then we also have lowballing. They tender, they win the contract. Why? Because they charge a lower audit fee than their competitors who tendered in. At the end of the day, their intention is that over time, they will increase it. Can you imagine that? So this year, we charge you 10 million, when the others were charging 17, 15, 20. Next year, you increase it to 12, to 15, to 20. Lowballing to win the tender should be looked at. Okay. I would like to split this into 2 sessions, just looking at my time, if time permits. Risky areas. Self-interest threat, any relationships we've mentioned this, any connection you have with the client, be careful, stay out. If you have a spouse, a child, okay, who holds more than 20% of the shares in the company you are auditing, you cannot proceed with the engagement, or you must pull out of that engagement. That person who is on audit team must pull out, okay? If I have a partner, a director, a shareholder, somebody who is key in the organization is my partner, I cannot proceed or be on that audit team, okay? These are not exhaustive, okay? You can get some more information there. Again, let's proceed. If an audit partner or manager joins the client, there should always be a change in the audit procedures and audit team. Okay, so I was part of the audit team. I was auditing HSBC, and then I joined them immediately, that team, because of course my team members would have known me. There's been some kind of familiarity. So they come and audit me next year. They know Richard was my friend. There could be some familiarity threat there. Okay. There's always a 2-year rule that if a member of the client joins the staff, okay, the auditor can't use them on this client's audit within 2 years. So HSBC staff joins KPMG. That HSBC staff who has joined KPMG cannot go and audit HSBC, assuming KPMG are the auditors of HSBC, unless this person has stayed with KPMG for over 2 years, then he can go and audit them. All right. Again, there is also prohibition on lending to audit clients. Okay, lending staff to audit clients. So what we are saying is that the audit firm cannot lend to the client. The client cannot lend to the auditor. But the client can lend to the auditor provided the rate they are offering the auditor is on commercial basis, the same as any other person who is contracting that loan, okay, on commercial basis. All right. I'll end at a point in time and come back so that the video can be short. Okay. Another risk area is corporate hospitality. Sometimes the audit client will want to take you for some dinner because you've done a good job, or just to establish that network. You can go for it, okay, but make sure it is at an arm's length transaction. It is reasonable. Is that what they do for all their consultants or evaluators who come to them? Okay. It is even required for you to disclose it to your ethics partner or quality review control partner, so that they will give you the permission that, okay, based on 1 or 2 reasons, you can't go. No, you cannot go. Okay. If they give you any gift, look at it. You must even disclose it, okay? Now, the safest rule is that you don't accept any hospitality if it will seriously affect your work. Don't accept it. On the other hand, if it will offend the client seriously, but it will not impair your judgment or your work, accept it. Okay, accept it. Always try to strike a balance. Attention should not be paid only to the actual value, but the perceived value. Okay, so I'm a Liverpool fan, an ardent football fan, for example. Now you realize that I like football, and then you give me free ticket for a Liverpool match, Liverpool versus Rangers in the Champions League, when Liverpool will score Rangers like 7-0 in Ibrox. When this happens, there is a case of some influence. They are influencing me because they know I love Liverpool. I'll go and watch the match. But if you are giving it to somebody who is not interested in football, that's okay. Okay, that's okay. All right. Again, let's look at financial trade, and we can wrap up and come back again. So what if you can, again, you cannot have interest in the client's shares? Anyone connected with you, your partner, cannot, okay? You cannot accept loans, like I said, unless it is at a commercial basis. Okay, everyone go for a loan from the client. It's offered at 13%. You go for it, it's given to you also at 13% interest rate. Okay, and again, you can't accept gift or hospitality unless the value is insignificant. But even with that, try to disclose it so that it doesn't impair your judgment. Okay, let's end here. We'll continue from conflict of interest. Okay. We'll continue from conflict of interest. All right, so friends, ethics will be in 2 parts. We'll continue from the conflict of interest section. Bye for now.